on Business Incorporated today. The 35th African Union meeting begins in Addis Ababa. Afrexim Bank supports energy in Africa through ECOWA gas. And Zambia creditors to take losses to meet up with IMF debt restructuring requirements. Hello and welcome to the final episode of Business Incorporated on Channels Television. I'm Ini John Mekwa. Well, let's start as usual with the markets in Africa. We see that most markets intraday were negative at intraday, and Nigeria and South Africa were both down marginally 0.07% and 0.02% each. Egypt's EJX index was also in the red at intraday. It shed 0.5% from the number, and the only positive was from yesterday, and that was Kenya's index, which went up almost 0.5% on Thursday. Quite the opposite in the Middle East. It was mostly positive at intraday. In United Arab Emirates, Abu Dhabi index was up by a marginal 0.06%, while Dubai climbed the most 0.57%. Elsewhere in the region, the Qatar index was up 0.35%. Only Saudi Arabia was negative. It fell by almost 0.5% at intraday. Moving over to Europe now, markets are expecting policymakers to be much more aggressive about raising interest rates against the decision of the European Central Bank. We have Chelsea joining us from Berlin now with the details. Hello, Chelsea. Well, markets are now preparing for the ECB to turn hawkish, and that's because of high inflation. The ECB had been adamant that inflation was only temporary. Now, what's the reason for this reassessment?
This is really a major shift from the European Central Bank because they had really insisted up until yesterday that inflation was going to be temporary, that it was transitory, and there was no need to really start to be removing some of that policy accommodation. So investors had really been expecting the European Central Bank to be one of the last developed market central banks to pull back on this ultra easy monetary policy. That's all changed now, and the reason is really because of inflation. Inflation is proving to be a lot stronger and more long-lasting than any policymakers here in Europe and really throughout the world had expected. So we just got new data on this yesterday as well. Inflation here in the Eurozone is up 5.1% in January. That's another record. And it comes as investors and economists had been expecting it to decline in January. So another shock there. A lot of that has been driven by energy costs here in Europe. And there had been hope that those would start to go down this year. But now there's, of course, the question of Russian supplies, whether those will be disrupted if there is indeed a conflict in the Ukraine. So that is no longer a given that energy prices will come down. As well, we're starting to see more long-lasting increases in the cost of things like food and manufactured goods as well. Wages are starting to go up. So all of this means that inflation is likely to be more permanent than policymakers had been expecting. And that means they need to move more aggressively on interest rates. So previously, the ECB had been saying that they are very unlikely to raise interest rates this year. Now investors actually expect them to raise interest rates potentially even 2 times this year. So for markets, for economists, this is definitely a really significant change.
Yeah, a lot of factors feeding into the inflation pressure there, Chelsea. And of course, like you noted, it's not just over there in Europe, it's all over the world. And what kind of impact can we expect this shift to have on markets?
Well, investors have said this is really stunning. So we have started to see that already have a big impact on markets. We saw stocks here in Europe, but also around the world, sell off on this perceived hawkish tilt from the ECB. As well, we saw the euro strengthen. So it's up about 3% this week. That's actually its best week since the pandemic started, since March 2020. As well, we're starting to see government bonds here in Europe sell off. The German bond yield is strengthening. Italian bond yields are strengthening, so that indicates that investors are starting to price that in. For stocks in particular, this is going to be a major challenge. This easy policy has also really been boosting stock prices here in Europe. Investors have been able to access credit and money very cheaply. That's been a factor in these record high stock prices. If we are really in a position where the ECB does change course, that will make conditions much tighter for investors, and that will put pressure on stocks.
And how will higher interest rates in Eurozone, how do we see it impacting blocs, poorer economies?
Well, that's always the challenge for the European Central Bank. It's that it's really presiding over an economy that has a lot of different strengths and weaknesses. Here, the concern is going to be the poor economies, the ones that are already facing financial trouble. The big one there is Italy. Italy is already emerging as a major concern because Italy has been very dependent throughout the pandemic on the European Central Bank. The European Central Bank, as part of its policy easing, has been buying a significant portion of Italian government bonds. That means that Italy has been able to borrow very cheaply because of the ECB. If the ECB does start to pull back on this, Italy could really start to face pressure. We've already seen a pretty significant reaction in the bonds of Italy. So yesterday, we saw the yield on a 10-year government bond go up by about 0.2 percentage points. In bond terms, that's pretty significant. So investors are starting to expect some significant challenges for Italy. We've seen this in the past when the ECB starts to tighten policy. This can turn into debt crises for countries like Italy, which has a debt to GDP ratio of over 150%. So that's definitely going to be a major concern. And of course, Italy may be the most problematic here, but there are a lot of other countries within the Eurozone that are also very financially vulnerable. Countries like Spain or Portugal also have high debt rates. So that's definitely something that investors are going to be concerned about as we go further down this path of the ECB really starting to change their monetary policy.
Yeah, and I'm sure we'll have more discussions on, the impact of this in other countries on the bloc. Thank you so much, Chelsea, and enjoy your weekend. We move to Asia now, where shares in Asia Pacific were higher on Friday as investors in the region shrunk heavy losses overnight on Wall Street that saw the tech-heavy Nasdaq Composite plunging. It plunged nearly 4%. Hong Kong's Hang Seng Index led gains among the region's major markets. It rose over 3% to close at 24,573.29. Financial stocks in Hong Kong surged today with shares of HSBC soaring almost 5%, while Standard Chartered jumped almost 5% also after the Bank of England yesterday announced its second straight rate hike. Markets in Hong Kong returned to trade today after being closed for most of the week, and they were celebrating their New Year holiday. Over in mainland China, markets remain still closed. They're still celebrating their lunar holiday. And South Korea's Kospi jumped 1.57% to close at 2,750.26. Elsewhere, the Nikkei 225 in Japan recovered from earlier losses. It closed at almost 1% higher at 27,439.99, while the Topix index climbed 0.55% to almost 2,000. The S&P AX 200 in Australia advanced 0.6% on the day to 7,120.20. MCSI's Broadex Index of Asia Pacific shares outside Japan rose 1.07%. In the U.S. now, stock futures rose in early morning trade today as investors digested a slew of corporate earnings report. After the Nasdaq Composite posted its worst day in more than a year. Futures on the Dow Jones Industrial shed 0.44%. S&P 500 futures was also down 0.08%, and Nasdaq 100 futures lost 0.60%. Yesterday, the tech-heavy Nasdaq Composite fell 3.7% for its worst daily performance since September 2020. The S&P 500 had its worst day in nearly a year. It slid 2.4%. The Dow Jones Industrial Average also fell 518.17 points. In the oil space, now prices climbed on Friday, recovering, we see, extending sharp gains in the previous session as frigid weather swept across large swaths of the United States, threatening to further disrupt oil supplies. Brent crude rose 42 cents to $91.53 a barrel, while U.S. West Texas Intermediate crude rose 52 cents to $90.79 a barrel, having gained over $2 the previous day to settle above $90 for the first time since the 6th of October 2014. Both benchmarks are headed for their 7th straight weekly gain. A massive winter storm swept across the central and northeast United States yesterday, where it was delivering heavy snow and ice, making travel treacherous, if not impossible, knocking out power to thousands and closing schools in several states. Tight oil supplies pushed the 6-month market structure for WTI into steep backwardation of $8.08 a barrel on Friday, 7 cents shy of an 8-year high of $8.15. That was for November 29 backwardation. It occurred when prices for prompt spots trade at a premium to future prices. In the metals market now, gold prices were supported by a weak dollar on Friday as markets awaited the vital U.S. jobs data that could impact the Federal Reserve's latest hawkish stance on monetary policy. Spot gold edged up 0.1% to $1,806.47 per ounce, and U.S. gold futures was up 0.2% at $1,807.20. If the upcoming jobs report out of the United States encourages the Fed's hawkish mood, it should lead to a significant breakdown in gold. Gold has gained about 0.8% so far this week as a pullback in the dollar lifted the appeal of the greenback-denominated bullion. Despite a rebound in a lot of Fed-impacted assets that weakened because of its hawkish stance and the dollar pulling back, gold has not been able to mount a rally, which indicates significant underlying weakness. Lingering concerns over Russia's invasion of Ukraine have also kept demand for the safe haven metal intact. Among other metals, spot silver added 0.4% to $22.48 per ounce. Platinum inched up 0.1% to over $1,000, and palladium rose 0.5% to $2,336.65 a barrel. Let's see what's happening on the African continent now. We see that President Muhammadu Buhari of Nigeria has arrived in Addis Ababa, Ethiopia, ahead of the 35th ordinary session of the Assembly of the African Union Heads of State and Government. The 4-day trip would be an opportunity for the president to join other African leaders in finding solutions to political, economic, and social challenges facing the continent. The theme of the deliberation is building resilience in nutrition and food security on the African continent, strengthen agriculture, accelerate human capital, social and economic development. And the United Nations Economic Commission for Africa estimates that Africa's internet economy will be worth $180 billion by 2025. Now, according to the Commission's Executive Secretary, Vera Songwe, the potential of the internet economy's power was put into test in Ethiopia and Rwanda last year. The Commission had worked with the government of Ethiopia and the government of Rwanda to be able to sell coffee. 11,200 bags were sold in 1 second through the internet, delivering about $72 million to small and medium scale. While following its full implementation, the African Continental Free Trade Area is expected to boost inter-Africa trade in agri-foods by 42%. We have more stories from the African continent, but that'll be after the break. Do stay with us. It's Business Incorporated on Channels Television. Welcome back. Well, Fund for Export Development in Africa, FEDA. It's a development impact-oriented subsidiary of African Export-Import Bank, Afrexim Bank, has invested into ESCO Gas, a liquefied natural gas distribution infrastructure platform in the West African region. And due to limited power supply from the grid, the industrial sector in Africa suffers severe energy shortages with attendant high production costs, inefficient operations, and reduced global competitiveness, among others. Off-grid solutions are required to address these challenges and put Africa firmly on the path to energy sustainability. Well, through this investment, FEDA is seeking to unlock access to affordable and cleaner energy for industrialization purposes and to significantly impact intra-regional trade, especially in West Africa. Let's go to South Africa now. Well, this week we've seen a lot of attention on South Africa, especially with the report that biotech firm Afrigen has produced the first mRNA COVID vaccine made on the continent, and that it will be ready for clinical trials in November. Good news for the continent. Cape Town-based Afrigen Biologics and Vaccines is leading the pilot project backed by the World Health Organization and COVAX initiative to tweak Moderna's shot. Meanwhile, there's also been easing of COVID-19 restrictions in the country. We have, to put all this together, Brian Pugeni joining us from South Africa now. Hello, Brian. Good afternoon.
Good afternoon, Nini. Thanks for having me.
Good to have you. Well, I know you must be so happy and proud now that South Africa is going to be bringing the first vaccine on the continent. What's the reaction? What's the feeling to this?
Well, it's very interesting news and very welcome news at the moment, being welcomed by every health practitioner, scientists, even the public at large. Because government's main aim is to push vaccines. So if the vaccines are being produced locally, that will actually push the drive to vaccinate almost everyone, because government has already been talking about mandatory vaccinations. So it will be easier for people to get vaccinated and the economy to get back to its feet. And then we see economic growth back to pre-COVID condition levels.
Yeah, and also there's been a reduction in the number of isolation days required. Tell us about how that works.
Well, government did reduce the number of isolation days for people who test positive for COVID and they have symptoms. That's where the difference is. If you've got symptoms, the number of days has been reduced from 10 days to 7 days isolation. If you test positive and do not have any symptoms, you can go back to work, which is good and has been welcomed by the by work and employers, saying that productivity won't be lost. So it's good news for companies, for business, that people won't have to go into isolation if they don't have the symptoms. But if you do have the symptoms, government has reduced that to 7 days, which is shorter than the 10 days we've been seeing before, which means people can get back to work and productivity levels won't drop, and the economy will get back to its feet.
Yeah, well, all efforts to bring the economy back. And also we saw during this week that Eskom resumed the stage 2 load shedding. Has the situation improved or what's going on there now?
Well, Eskom did announce stage 2 load shedding as from Wednesday. They're saying it's going to end on Monday, which is not good for the economy, which is starting to pick up. We saw January, a lot of industries recovering, but we're starting off February on a bad note. It's not good at the moment because Eskom did say that last year was the worst. We saw the worst days of load shedding, where there was a total of 51 days of load shedding. So they're saying this year we might even see 61 days of load shedding. So we're waiting for an announcement by Eskom later on today. They're saying the grid is a bit better today. So they're going to announce later on around 5 in the evening to let us know whether they're going to continue with load shedding or they are not. But it's not good for businesses, it's not good for production, it's not good for the economy.
Yeah, well, 51 days of load shedding. But you still have your data showing that new vehicle sales increased in the year. And so we're trying to understand, where did it come from?
Well, it's very contradicting, eh? Some of the industries are doing well, while some of them are not really doing well. But new car vehicle sales going up in January was an increase of 26.6%, which is quite a significant jump from what we saw last year, where 23,000 vehicles were sold. But this year in January, they're saying over 30,000 units were sold, which is good for the economy and that industry as well, the motoring industry. And experts are saying that that industry is going to see an upward trend for the next couple of years till 2024, which is good news for the motor industry. Though we did get some bad news on the other side, fuel going up again this month. So we don't know how that is going to affect vehicle sales going forward.
Yeah, well, it's a big mixed bag there. You have some good news from COVID, you have the fuel, bad news, and then you have the vehicle. Well, wish you all the best. I guess it's just natural at this time. Thank you so much, Brian. Enjoy the rest of your holiday, of the weekend. I beg your pardon.
Same to you.
Yeah. Well, let's leave South Africa. Now we go to Tunisia, where they're getting support from the United States as the U.S. has launched the Visit Tunisia project at the archaeological site with a fund of $50 million. The project, which is funded by the U.S. government through the U.S. Agency for International Development, extends over a 5-year period and aims to help the vital Tunisian tourism sector to recover through partnerships with the public and private sectors, as well as through digital innovation. The project is expected to contribute to creating 15,000 new jobs in the sustainable tourism sector in Tunisia's marginalized regions and support small tourism enterprises. It also aims to increase the spending rate of visitors by 20% and the number of tourists to 11.5 million by 2026. Zambia's creditors would have to take losses of about 2/3 if the country is to meet the International Monetary Fund's requirement for a debt restructuring, according to an alliance of local activist organizations and the Jubilee Debts Campaign UK. The Southern African nation, which became the continent's first pandemic-era defaulter in 2020, has the capacity to repay about $2.8 billion and $3.5 billion of debt over the next 14 years. About $7 billion would have to be written off, implying a haircut of between 64% and 71% for private and bilateral lenders. Zambia needs to secure an IMF economic program to complete a debt restructuring under the Group of 20's Common Framework for Debt Treatment. The nation owes external lenders about $17 billion, including debts of its state-owned companies, with more than 1/3 of that owed to Chinese entities. Meanwhile, Zambia Development Agency will continue to support the construction of a China-invested fertilizer manufacturing plant. United Fertilizer, a subsidiary of the Chinese firm Wonderful Group, launched the construction works of its $300 million fertilizer plant in November and is scheduled to launch officially in July, with the expectation to produce 300,000 tons of fertilizer annually after it's been launched. The agency is targeting not just the local markets, but also the export market as well. And fish is worth a whole lot in Tanzania. Fish worth 166.5 billion Tanzanian shillings were traded in the registered markets during the quarter ending September last year, which is 54.4% higher than 107.8 billion shillings in a similar quarter in 2020. And it was driven by volume increase following favorable weather and increased use of proper fishing tools. According to the Bank of Tanzania Consolidated Zonal Economic Performance Report, a total of 37,840 tons were traded in the market during the period under review, compared to 17,990.7 tons in the corresponding quarter. All zones recorded an increase, with Lake Zone representing 64% of the total value of fish sold in the markets. And in Kenya, First Mortgage Refinancing Bank is selling 10.5 billion shillings medium-term note, whose proceeds will be lent out to commercial banks to increase affordable home ownership. The non-deposit taking Kenya Mortgage Refinance Corporation, which is jointly owned by commercial banks, savings, cooperatives, and the state, said it's offering 1.4 billion shillings as the first tranche of the bond. The note will have a tenure of 7 years with amortization and a fixed rate of 12.5%. And the first tranche will be on sale on the 18th of this month. That's it for this week. Thank you so much for being a part of our journey all through this week here on Business Incorporated. Let's do it again next week. I'm Ini John Mekwa.